How to file your U.S. tax return while living in Canada. If you live in Canada, pay your taxes to the CRA, and consider yourself Canadian, this video might surprise you because almost every week I meet clients who have lived in Canada for 10, 15, even 20 years, and then suddenly they receive a letter from the IRS saying they still need to file a U.S. tax return. The reaction is always the same. Why would I file taxes in a country where I don't live, don't work, and don't use any public services? If that sounds familiar, you're not alone. And today I'm going to explain exactly who needs to file, what income must be reported, and how most Americans living in Canada avoid double taxation entirely. Who needs to file? Let's start with the most important question. Who actually needs to file a U.S. tax return while living in Canada? The short answer is this. If you have a U.S. passport or a green card, the IRS likely expects to hear from you every year. Unlike Canada, the United States uses citizenship-based taxation. That means your tax obligation is tied to your status, not where you live. You generally must file if you are a U.S. citizen, even if you left the U.S. as a child, a dual citizen of Canada and the U.S., or a green card holder, even if you moved back to Canada years ago. And here's a very common trap with green cards. Letting your green card expire does not end your U.S. tax obligations. Until you formally abandon it by filing Form I-407, the IRS continues to treat you as a U.S. tax resident. In some cases, additional tax filings may also apply. What income must be reported? This is where many people get uncomfortable. A lot of Americans in Canada assume, I work in Toronto, I paid in Canadian dollars, surely the IRS doesn't care. Unfortunately, the IRS cares. The U.S. requires reporting of worldwide income, regardless of where you live or where the income is earned. That includes salary from a Canadian employer, self-employment or consulting income, rental income from Canadian properties, interest and dividends from Canadian bank accounts and investments, CPP and OAS, capital gains from selling Canadian stocks or real estate. Everything is reported in US dollars using IRS-approved exchange rates. Now, reporting does not automatically mean paying US tax again, but disclosure is mandatory. How Americans in Canada avoid double taxation. Here's the good news. Most Americans living in Canada do not actually owe US tax, but you must file the correct forms to prove it. There are two main tools. The first is Form 2555, the Foreign Earned Income Exclusion. This allows you to exclude a large portion of earned income, generally over $130,000 US dollars adjusted annually. But there's a catch. It only applies to wages and salary. It does not help with investment income, rental income, or capital gains. The second tool, and often the better option for Canadians, is Form 1116, the Foreign Tax Credit. Because Canadian tax rates are usually higher than US rates, the tax you pay to the CRA can often wipe out your US tax, dollar for dollar. Any unused credits can be carried forward for up to 10 years. FBAR and FATCA, where penalties arise. This is the part that causes the most anxiety. The US requires disclosure of foreign financial accounts. First is the FBAR, also called FinCEN Form 114. If the combined highest balance of all your non-US accounts exceeds $10,000 US dollars at any point during the year, even for one day, you must file it. This can include checking and savings accounts, RRSPs, TFSAs, and certain life insurance policies with cash value. Penalties for missing this form can start at $10,000 US per year, even if no tax is owed. The second form is Form 8938, often referred to as FATCA reporting. This applies at higher asset levels, generally starting around $200,000 US, with higher thresholds for married couples. Deadlines for Americans abroad. There's one small perk to living outside the US. April 15th is the payment deadline if you owe US tax. June 15th is the automatic filing deadline for Americans living abroad. October 15th is available if you formally request an extension. If you owe tax and wait until June to file, interest still accrues from April. Common mistakes we see. 3 mistakes come up again and again. First, assuming that no tax owed means no filing required. Treaty benefits only apply if you file. If you don't file, the IRS assumes full tax applies and the statute of limitations never starts. Second, ignoring TFSA implications. The IRS does not recognize the TFSA as tax-free. Income earned inside a TFSA is generally taxable each year for US purposes. Third, holding Canadian mutual funds or ETFs outside an RRSP. These are often treated as passive foreign investment companies, or PFICs, which trigger punitive taxation and complex reporting on Form 8621. When to get professional help. If your situation is extremely simple, modest income, no investments, no property, you might be able to manage this on your own. But once you add investments, rental properties, corporations, or years of misfilings, the risks increase quickly. This is something we deal with every day. If you're unsure whether you're filing correctly or you're worried about past mistakes, it's better to fix it proactively. If this video helped, feel free to like and subscribe. And if you like personalized advice, you can book a consultation using the link below.